Good day, everyone. My name is Dr. Kofi Ejakun Abebio. I'm a senior lecturer in the Department of Mathematics and Statistics, Kumasi Technical University. My research area is into behavioral economics, where I focus much on investor decision-making process and failures. My topic that I'll be presenting today is hedging behavior in emerging market, application of Bayesian quantile regression, and my co-author is Professor Beatrice Deviation in the School of Economics, University of Johannesburg, South Africa. In today's presentation, I'll be testing hedging behavior during financial crisis, where I have segmented the period into three. The first part will be the period before the financial crisis, the financial crisis itself, and the period after the financial crisis. And in each of these segments, I'll be looking at extreme returns. That is the bear, the normal, and the bull market days. And then check when investors do exhibit hedging behavior. Sit back and enjoy my presentation. Thank you. Good day, everyone. My name is Dr. Kofi Ejakun Abebio. And in this colloquium, I'm presenting on the topic hedging behavior in emerging markets, evidence from Bayesian quantile regression. And my co-author is Professor Beatrice Deviation, School of Economics, University of Johannesburg, South Africa. I'll proceed as follows. I will start with my introduction, related studies, methodology and data, results, and conclusion. When we talk about hedging, what is hedging? I want to spend a few minutes to explain what hedging means, especially in financial market. In financial market, we have different financial market. We have the stock market, we have the cryptocurrency market, we have the Forex market, and we have other markets as well. So when we talk about hedging behavior, simply we're talking about following the crowd. Following the crowd. So what others are doing, if you follow what they are doing, then you are exhibiting the behavior named as what? Hedging behavior. Now, hedging behavior occurs when individual investors follow the crowd instead of their own belief. Now, this can lead to significant mispricing and might create additional risk in financial market. Hedging causes individuals to overvalue public information and undervalue private information. It plays an important role in the stability and liquidity of the financial market, according to Iron School 2012, Pone et al. 2013. The importance of human behavior and its effect on the financial market has recently generated several studies into the analysis of large-scale data regarding financial topics appearing in the media. These analyses include, but not limited to, the following studies: mood analysis on Twitter, we have Bolin, Mao, and Zink 2011. We have search volume analysis on Google. We have article view analysis on Wikipedia. And then we also have analysis of financial news. That one was also rated by Alayali, Moot, and Price 2013. Sample studies, as I've indicated here, demonstrate the correlation or the interdependence between financial market moves and behavioral trends reflected in various media channels. Now, the objective of my presentation today is to test evidence of hedging behavior among investors in emerging markets using quantile and Bayesian regression models before, during, and after the Great Financial Crisis in 2008. Now, we will also check evidence of hedging behavior will be tested during bear, normal, and bull market days. When we say bear market day, when the market portfolio returns is very low, and when we say bull market days, when the market portfolio returns is extremely high, and the normal are ordinary returns in the market. Now, data that we used daily data on 17 emerging market, that's equities, and the period that we considered was January 2004 to December 2011. The source of our data is, we got this data from Bloomberg. Now, there's this hypothesis, according to Chan et al. 2000, Lobo and Sarah 2002, Tan et al. 2008, Lau and Singh 2011, and Economo et al. 2011. They found that investors are more susceptible to hedging behavior, especially during extreme market days. So we expect investors to hedge, especially when the market is experiencing low market portfolio returns or extremely high market portfolio return. We want to see and check if during the financial crisis in 2008, if investors indeed exhibited the hedging behavior as indicated here. Now, the method that has been used to test hedging behavior over the years, the Penier method, was introduced by Lakonishok, Schleifer, and then Visny, that's LSV measure. And this measure, normally called the LSV, assesses the buying and the selling tendencies of investors for a particular stock, or let's say asset. And then the second one is the cross-sectional standard deviation, also introduced or proposed by Crises and Juan in 1995. This model also adopts a dummy regression and makes it difficult to detect the presence of hedging behavior. An update of this model is the cross-sectional absolute deviation. Under non-normal conditions such as extreme movement, the bear, normal, and the bull, investors behave in a similar way, imitating each other, which leads to the market portfolio dispersion to be clustered. Now, we are proposing, or we want to use another approach, and the approach that I want to use here is the Quantile approach. We know that simple linear regression, multiple regression, these models are sensitive to outliers, and we want to try Quantile regression, which is not sensitive to outlier, and also look at its other form in the Bayesian framework. And again, we will validate our results using Bayesian regression with normal errors and t-distributed errors. The t-distributed errors and the normal errors will be used to validate the Quantile Bayesian regression. Now, the model, the cross-sectional absolute deviation are the model as displayed on the slide. The first model is when we are testing the normal market days. The second one is when we are testing the extreme lower market portfolio market. And the last one is when we are testing extreme higher market portfolio returns. CSAD is market portfolio dispersion, and then the small RMT is the market portfolio return. Now, a significant and negative beta 2D, and the beta 2U signify evidence of hedging behavior. So when we do the empirical analysis and the coefficient of our RMT square is negative and also significant, then there's evidence of hedging behavior in the market. Now, return was captured as this: the lane of the price today divided by the price yesterday times 100%. And how to capture the cross-sectional absolute deviation is just 1/n summation of the individual return minus the market portfolio return. We take the absolute value of that. So RIT is the asset returns, the PT is the adjusted close asset price on day T, and last, the PT minus 1 is the close asset price on day T minus 1. Now to the empirical results, the first one is just the descriptive statistics, where we have divided the period into three. The first one is the period before the crisis, the second one is the period that's the crisis, and the last one is the post-crisis. So before the crisis, we captured January 2004 to December 2011. And then within the crisis, we captured January 2004 to December 2005. And after the crisis too, we captured January 2006 to December 2009. We did this one for the returns and also for the dispersion. Now we move on to the time plot of the market portfolio. And you could see that, you can observe that during 2008, the volatility was too high. This was also captured when you check the dispersion, the cross-sectional absolute deviation. If you check around 2008, you see a jump there. You see a stabilized time plot, but when you get to 2008, you see some jumps over there. Now we move on to the results, the Quantile and the Quantile Bayesian results. If you check our results here, considering the bull and the bear, for both the Quantile regression results and also for the Quantile Bayesian or the Bayesian Quantile regression, you will notify that, you will see that we found no evidence of heading behavior during the pre-crisis, crisis, post-crisis, and then the entire period. We found no evidence of heading behavior during the pre-crisis, crisis, post-crisis, and the whole period. The same thing was also observed here when we used the Bayesian quantile regression during the bull and the bear. Now we want to also validate these results with the normal Bayesian regression, where we assume that the innovations are normally distributed or T-distributed. And when you check the results here, you will see that when we use the Bayesian regression with T-distributed innovation, we found evidence of heading behavior. We found evidence of heading behavior during the crisis, when the market portfolio returns was less than 1%, when it was less than 5%, and when it was also less than 10%. So it means that during the crisis, when the market portfolio return was lower, most of the investors exhibited the heading behavior. In the same way, when we combine the entire segmented period together to form the total or the entire period, we also found evidence of heading behavior during the bear market period. And the bear market period, the threshold that we used was that when the portfolio return, market portfolio return was less than 1%, 5%, and then 10%. We equally saw the same evidence also here. Now to the conclusion, my key findings here, the key finding that we found in this study is one, no evidence of heading behavior that before, during, and after the financial crisis was found using the Quantile and the Bayesian Quantile regression models. And also, when we considered the robustness test, we found evidence of heading behavior during the bear market period only. During the bear market period only. That is when the market portfolio return were extremely lower, using the Bayesian regression model with T-distributed innovation during the crisis and the entire study period. For further work, we suggest that further studies could test the presence of heading behavior during the same period under investigation, but using high frequency data. Thanks so much, and your questions are welcome.